Well, welcome everybody to our Q1 2024 market wrap-up. My name is Matt Edgar, and I'm the principal here at Edgar Investment Management. And helping me out with this presentation is Patrick Klein. He also works at Edgar Investment Management. So we're going to take you through the first quarter of 2024. So real quick, a little brief overview of what we're going to be covering today. We're going to look at, sort of some hot topics for the quarter. We're going to take a look at some performance across sectors, across industries, across countries. And then we're going to do a little bit of Q&A at the end. Also, of course, we've got some disclosures. Information presented in this PowerPoint is based on historical data. It's just for your information only. There's no recommendations with regard to investments in here. So with that, let's go ahead and jump on in. So first of all, what are some of the new things that are going on at Edgar Investments? Well, if you subscribe to our newsletter, which I hope you do, you might have noticed in the last few weeks, we've sort of changed up our newsletter. We've made it a little bit shorter, made it a little bit quicker to read. I like to call it a light scroll. You just have to scroll a little bit to get all the content. But we've also, more importantly, we've also added some content that's exclusive to our newsletter only. So we had been sort of wrapping up and summarizing what we were going over during the week, what we were talking about on our blog, what we were talking about on social media. Now we're actually putting in some original content into our weekly newsletter. So be sure to subscribe to that if you're not already. If you are subscribed to it and you're getting it, be sure to read it because every week we have lots of really good information in there. We also have introduced a sort of a way of thinking about a person's financial journey. We like to call it the rise, run, relax. There's sort of three phases that most working individuals are in at any given point in their life. The rise is where you're sort of getting out of bed, you're really establishing yourself, you're starting to build your investments. You've got a long horizon in terms of your working years. Then you move on to the run phase. This is where you're sort of mid-career, probably your income is at its peak. You're really saving a lot, but you're really getting ready for that final phase, which is the relax phase. And that's retirement, right? That is where you're no longer earning income. You're actually spending your assets down and able to relax and enjoy all of the hard financial work that you did throughout the course of your life. So, we kind of use this to think about our clients and what phase they're in, the rise, the run, the relax. Where are they? And this sort of dictates how much risk they can take, what their time horizon is, what sort of expected return we want to get them. So it's just kind of a nice way of thinking about a person's financial journey. And then, of course, we always have our investment learning lab on our website. If you haven't checked it out, it's absolutely a fantastic part of our website. Every day we have a blog that goes up there that Patrick writes, kind of recaps what has happened in the day before. If you haven't seen it, you definitely have to go check it out. And then, of course, we're on YouTube. This video specifically will be on YouTube. So if you know somebody that missed the video, definitely have them go over to our YouTube station and our channel and take a look. All right, so let's jump into some discussion on the markets. So here we've got on the left-hand side of this slide, we've got our style boxes. So as a reminder, when we talk about style, we look at value versus growth, first of all. So value are typically your, I hate to call them cheaper stocks, but those are sort of your high dividend producing. They're not your very flashy stocks. These are your utilities, your insurance companies, your financials. And then on the other side of that spectrum, we have growth. And growth are those high flying stocks, those sort of technology stocks. They don't pay a dividend typically, but they're growing. The price is appreciating. And then a blend, of course, would be in between those. But then we also look at stocks in terms of their size. We call it market cap. So we've got small, mid, and large. Small cap stocks are just that. They're just those really small companies that are hopefully growing, hopefully getting bigger, all the way up towards your large cap stock. So, one thing we saw in Q4 of 2023 is there was really pretty pretty strong performance across the whole spectrum. Whether you were looking at large growth, small growth, even a blend. I mean, we had really strong performance across the board. Q1 of 2024, we still have strong performance, but you can see sort of the moderation of that green. It's good performance, but it's not quite as strong as Q4. That being said, if we have a 1 year look back from Q2 2023 through Q1 2024, really strong growth throughout that 1 year period. You can see that large cap growth number has just really, printed a really nice, almost 40% return, 37.27%. But really across the board, it's just been a really good 12 months. Now, this large cap growth, this is our Magnificent Seven, and we're going to talk about the Magnificent Seven here in a few slides. But this is our Nvidia, Facebook, Meta, Apple, Tesla. There's really been a lot of excitement among investors in this sort of large cap growth bucket. But overall, for the last year, we've had strong performance across the board. And we're going to drill down into that here in a little bit. Okay, so one thing that everybody always is talking about these days is the Fed and what the Fed is doing with interest rates. So over here on the right-hand side, we just have a table of Fed actions over the past year. And you can see we have been on a bit of a pause streak lately. We haven't had a rate change since going all the way back to the middle of 2023 when we had a slight increase, 25 basis point increase. Now, there's a lot of speculation with regard to what the Fed is going to do. The Fed is trying to manage inflation. And I like to think of inflation and rate increases specifically as sort of like an infection and antibiotics, right? Where inflation is the infection and rate increases or decreases are the antibiotics. And just like when you go to your doctor because you have an infection, they're going to give you a 10-day prescription for antibiotics. And they're always going to say the same thing, right? Make sure that you take all of your antibiotics. You have to take all 10 days or whatever the course might be. Because if you don't, if you stop short of that 10-day prescription, if there's any sort of bacteria or infection in your body, not only can it come back, but it can come back even stronger. And so I think that's sort of an analogous, or that's analogous to what we have here on rates, right? The Fed doesn't want to back off and decrease rates too quickly because inflation is that infection, and we could see inflation come back, and it could come back even stronger if the Fed begins to decrease rates. So that's what a lot of people are asking about, right? What is the Fed going to do? And originally, think about maybe November, December of last year, a lot of prognosticators were saying, well, the Fed's going to decrease rates 3 times next year. 3 times. They're going to decrease rates 3 times. And as we sort of moved into Q1, a lot of those predictions went from 3 times, in 2024 to 2 times in 2024. And what we're starting to hear very recently, in fact, in the last just couple of weeks, specifically Chairman Powell this week talking about, they're not in a hurry to decrease rates. And I think that's because they want to make sure they've got inflation under control. They want to sort of tame that infection of inflation. So around here at Edgar Investment, we obviously don't know what the Fed's going to do, but we're sort of targeting 1, maybe 2 decreases this year. But I would say if they do happen, they're going to be very late in the year. Not at any of these upcoming meetings. So maybe look for 1 rate decrease this year, possibly two. But we'll keep you updated on that with all of our quarterly updates. We also talk about what the Fed is doing on our daily blog, and we talk about it on our newsletter, of course. So stay tuned to those different ways of getting in contact with you. So let's talk about the Magnificent Seven, right? If you're familiar with this, people also call it the Mag Seven, the Magnificent Seven, and these are sort of the seven high-flying technology-related stocks from 2023. And so, what are the Magnificent Seven? Well, it's NVIDIA, the microprocessor company. It's Meta. We all know Meta, Facebook, Instagram. It's Amazon. Of course, everybody knows Amazon. Probably most people have an Amazon package waiting on your front doorstep right now. Microsoft. Most of us are probably using a Microsoft computer. Google. Of course, we all Google stuff on a daily basis. Apple, famous iPhone maker, computer maker, and Tesla, the automotive company. So all seven of these stocks just really went gangbusters in 2023 and really just moved the needle for large cap growth, but also really moved the needle for the S&P. I mean, they really were, sort of the main drivers of return for the S&P. So how are the Magnificent Seven doing this year in quarter one? So we took a look at the cumulative returns beginning with the first trading day in 2024 up through the last trading day of the quarter. And it's really a mixed bag, right? You can see NVIDIA has returns this year, or for the quarter, first quarter had returns of 87.59%. I mean, still just, a really amazing performance from NVIDIA. But at the other side of that spectrum, Tesla was down 29.24% in the quarter. And you can see a very wide dispersion of returns among this Magnificent Seven. So, to some extent, they're kind of going their own way this year. There's still some really high performers in here. Of course, we talked about NVIDIA. Meta, Facebook has done 40% for the quarter, for the first quarter. Amazon and Microsoft are in easily double digits. Even Google's printing 9%. Apple and Tesla, meanwhile, are sort of struggling for the year. Now, this is a little bit, I know we're talking about Q1 here, but this is a little bit of a different story for Q2. For Q2, the S&P has actually been down, and NVIDIA and Tesla are also down as well. So, it's not necessarily. Let me give you the numbers on that. In fact, so the S&P is down 4.4% in Q2. NVIDIA is down 6.79%, and Tesla's actually down 11.57%. So Q2 has not actually been a very good start for the Magnificent Seven. Tesla's really struggling this year. So, let's kind of move on and talk about how sort of investments apply to, our kind of everyday life and our clients. And so one of the things you'll see on our new updated newsletter is a weekly reality check. Patrick came up with that title, and I really like it. It's a reality check. It's just sort of letting you understand, where sort of your finances, where your investments, where your financial life fits in the overall scheme of everybody's financial life. And so what we wanted to do on this webinar is we wanted to take a look at net worth, specifically net worth based on your age group. So you can see down here, we have less than 35, 35 to 44, 45 to 54, 55 to 64, 65 to 74, and then 75 plus. And this is a really handy tool because I think a lot of times clients don't always comprehend where they are relative to sort of the overall, their overall peer group. And so this is just a really nice way to just literally come in and find where you sit in the age group, and then just sort of look at how your net worth compares to to the average net worth and then the median net worth. Now, if you remember back to your statistics, average is sort of you take all the numbers, you add them all together, and you divide by however many observations you had, where median is in the middle. It's the middle measurement. And you can see there's a very wide discrepancy here between the average and the median, letting us know that there's a lot of wealth concentrated with sort of the top end of the spectrum. That's what's dragging this average number up. What I like to say here is that, let's pick a number 35 to 44. If you're in this 35 to 44 age bracket, this is sort of a nice little ladder that you can climb up, right? If you're under $135,000, then your goal is to get to the median net worth. Get yourself to that 135. Once you get there, or if you're already there, then that next goal is to get to the average. And then once you get to that average, then of course your goal is to exceed that. Because the more wealth you have, the more you're setting yourself up for retirement success. And not just retirement success, but success in whatever your financial goals might be, whether that's paying for a kid's tuition, starting a new business, taking a nice vacation, buying a second home. We obviously want to have more net worth than less. Sort of staying in that same idea of a reality check, now let's take a look at retirement savings. And, we kind of have a nice eye-catching title here, Retirement Savings in Crisis. Do we have a crisis in retirement savings? Well, this information is from Northwestern Mutual, and they did a survey and they looked at retirement accounts. So this does not include your taxable investment account. It doesn't include the equity that's in your house. If you own a business, it doesn't include the value of that business. This is really just looking at retirement accounts, 401ks, IRAs, Roth IRAs, simple IRAs, SEPs, 403bs, any sort of account that is a preferential retirement account. And what Northwestern Mutual found is they asked people in different generations. So we're not looking at age groups here so much as we're looking at generations. So we have Gen Z, which are our really young people. Not all of them are even working yet. We have millennials, we have Gen X, and then we have our baby boomers. And they asked each of these generations, how much money do you need to have in order to retire comfortably? And you can see, there's fairly consistent answers across the board. Gen Z thought they should have 1.6 million. Millennials thought 1.65 million. Gen Xers, a little bit more thrifty. They think they should have 1.56 million. And then baby boomers think they should have $990,000, just a little under $1 million. Then what Northwestern Mutual did is they went and looked at how much these groups actually have on average in their retirement accounts, in those 401ks, IRAs, etc. And what they found is that the retirement savings is woefully deficient in order to provide for retirement. So you can see Gen Z right now has a shortfall of $1.6 million. Now that's not as concerning because Gen Z has really just entered the workforce. I think the oldest of Gen Z is maybe approaching 30. So on average, they haven't been working very long. Millennials have been out a few more years, but they're short about $1.6 million almost. Now Gen Xers and baby boomers. Now these are the generations that have been working. In fact, baby boomers are really starting to retire. In a few years here, most baby boomers will be retired. But Gen X has been in the workforce now for 20 plus years. And we have a significant shortfall in those retirement accounts. You can see Gen X is short by about 1.45 million. Baby boomers are short almost 900,000. Now, this may not be a concern as much as these numbers might show us because there are other resources, right? Especially most baby boomers and Gen X have some equity in a home. They might have some taxable investment accounts. They may even have been working, on a business for years that they're going to be able to sell when they retire. But what this does show, or what this does tell me as sort of an investment advisor, is that pretty much across the board, generations are not taking full advantage of these tax advantage accounts, right? So whether it's a 401k, which you're getting a match from your employer, or it's an IRA that you're able to, defer tax on, there's probably, not, these groups are probably not optimizing those accounts as much as they should be. So, we always say with regard to like a 401k, your floor should be what your employer matches. You shouldn't contribute any less than your employer match. So if your employer matches dollar for dollar up to 3%, you absolutely should be contributing 3%. Now, your max on a 401k is whatever the statutory limit is for that year. Currently we're in the low 20,000 mark. So you should be trying to maximize your 401k. Same thing on the IRA. Now, obviously on an IRA, it's an individual retirement account. There's not the employer match, but there is a regulatory and IRS limit. And you should really try to be contributing to that IRS limit. Because these are tax advantage accounts. So the more money you have here, the more advantage you've taken of those tax provisions. So just a little bit there on, some sort of personal financial planning, where you are with regard to your net worth and where you are with regard to your retirement savings. So we really want clients to really focus on, just saving more and funding those accounts for their future retirement, for their future financial goals. Okay, let's switch gears a little bit more here. So we talked about the Magnificent Seven. I know we're going back and forth a little bit, but hopefully that keeps it engaging and keeps you interested. So let's talk a little bit more about that Magnificent Seven. A lot of companies are do really, really, really well. And you think, man, this is just never going to end. I mean, this company, I don't want to pick on any specific company because I don't want to give any specific investment advice or perceive to give any investment advice here. But, I will pick on BlackBerry because we can see what's happened to BlackBerry in the past, right? If you look at BlackBerry, I mean, think back to, let's say the year 2006. I mean, every business person had a BlackBerry. Every single person had a BlackBerry. Maybe they had two. And everybody lived with their BlackBerry. I mean, you couldn't pry a BlackBerry out of somebody's hands. And if you would have asked somebody back in 2006, what do you think the future looks like for BlackBerry? Well, of course, everybody would have said, oh, BlackBerry is the best thing that's ever happened. I mean, they're going to be around forever. It's a great company. It's probably a great investment. In fact, if somebody would have said, "Oh, BlackBerry is no good," you would have thought they were crazy because everybody had a BlackBerry. Well, then in June 2007, Apple comes out with the iPhone, and they absolutely just sort of changed the game. I mean, if you go back into that time period, the Apple device, it seems a little bit probably ancient now, but I mean, it was pretty revolutionary. It had a touch screen, full screen. It didn't have the QWERTY keyboard like the BlackBerry did. It worked really well. If you think back to like the BlackBerry Storm that tried to have the touch screen, didn't work as well. And then in September of 2008, Android comes out. So now we've got Android on Samsung phones, LG phones, and now we've got a little bit of competition for the BlackBerry. We've got the iPhone and we've got the Android phones. In March 2011, Android surpasses BlackBerry in the US smartphone market. Now, this little mountain looking here is BlackBerry's 12-month sales per share. And you can see it topped out in 2011 and just fell off a cliff. Where's BlackBerry now? Well, I think you'd be hard pressed to find anybody that thinks BlackBerry has a super bright future coming out. So just because a company has done really great things in the past doesn't mean that's going to last forever. So Here's some examples over here in the write-up. I mean, famously, we can think about Sears. I mean, Sears used to be absolutely, huge. I mean, back around the early 1900s, you could order a whole entire house from Sears. They would ship it to you on a rail car, and you could put it together yourself. Of course, AOL. I mean, if you were on the internet in the 90s, you were on AOL. AOL was absolutely, the center of the internet, not so much anymore. And then we got to go back a little bit, talk about Friendster, or even MySpace. Those were popular social media back in the very beginning of social media. I mean, they're all but gone now. Facebook, Instagram, Twitter, TikTok, those have just taken over. So, be careful at looking at what a company has done in the past to sort of extrapolate that out into the future, because there's plenty of examples of companies that have done really well and just sort of lost that competitive edge. All right, but let's kind of switch gears now and let's really get into talking about the quarter and how the quarter performed. So, across the board, with the exception of global real estate and the US bond market, it was a good quarter. US stocks were up a little over 10%. International developed stocks were up 5.59%, almost 5.6%. Emerging market stocks were up 2.37%. The difference there between developed and emerging, developed are those countries that we tend to think of as being a little bit further down that economic development curve. So think of, places like Australia, UK, most of your Western European countries, Germany, Japan, going over to Asia. Emerging markets are going to be those markets that are sort of established, but sort of climbing through that economic cycle. So think of South Africa, uh, South Korea, Brazil, some of those, developing but not quite developed countries. So, across the board in equities did pretty well. Real estate, global real estate was much softer, losing about 1.2%. And then bonds, it was a mixed sort of bag. U.S. bonds didn't fare so well in the first quarter, down slightly, to negative 0.78%. Global bond market did okay, eking out a positive return of 58 basis points. If we look back at a little bit longer term returns, if you look at the 1 year across the board, everything's been up. U.S. stock market is up almost 30%, but international developed is up over 15%. Emerging markets, which have really struggled in the last 5 to 10 years, is up 8% on the year. Global real estate, even though it was negative for the quarter, is up for the year 7.44%. U.S. bonds and global bonds are up. You can think back to 2022 and 23 when bonds were down. So we've had sort of a turnaround in the bond market. If we go back to the 5 year, again, U.S. stock market is up, just green across the board. And then, of course, if we go to the 10 year, this is what we'd expect. We expect, long-term returns to be positive. You will note that there is some weakness here in emerging markets. I mean, emerging markets has struggled over the last 10 years, eking out a return less than 3%. Even international developed markets have while positive, have been less than 5%. U.S. stock market has been, really strong over the last 10 years. So let's take a look at for the quarter. There's been a whole host of things that have happened in the quarter. These are some of the highlights, of course. S&P 500 closed first record high in 2 years. This was really fueled by that Magnificent Seven. We've talked about that here. U.S. job growth, jobs continued, we continue to see the job market just adding jobs across the board. And this is not helping inflation, right? I mean, job growth and inflation sort of go hand in hand. So that's part of the story there. Interesting enough, in the quarter, Japan has had negative interest rates for quite a while now. They've actually increased their interest rates to above zero. So that sort of ended the global era of negative interest rates, which is a pretty interesting phenomenon. And we're going to see Japan's yield curve here in a few slides. If we pull back a little bit more and look at the 12-month, in terms of sort of geopolitical happenings, of course, we had Hamas attacking Israel, Israel returning that and declaring war on Hamas. This is still, an ongoing issue, of course. Anybody that watches the news knows that. And then we did have the U.S. Senate approved a measure averting a government shutdown. This is sort of a continuing conversation that we're having among, the Washington, D.C. folks. There's still a lot of contention with regard to, both sides, Republicans and Democrats. We have seen compromise on this front, even between some of your sort of hardline Republicans and left, Democrats. So that's good. I mean, it's good that our government doesn't shut down. That's good for the markets, and I think it's probably good for people in general. So let's take a look at country returns. So if we go back and look at the fourth quarter of 2023, so this is revisiting, our fourth quarter 2023 discussion. You can see here in blue, this was the global country returns. US is slightly above the global, so it's positive. There were only a few countries, Turkey, China, the UAE, and Kuwait, that were in the negative. So that was, for the most part, the fourth quarter was a very positive quarter across the board for every country. Skipping forward to the first quarter of 2024, you can see that the global market was still positive, and US still beat the global market. But one thing you'll see is, there's not as many countries, or I should say, there's a lot more countries that have had negative returns in this first quarter. So it's not quite as rosy a picture as it was back in Q4 of 2023. So a little bit more of a mixed bag. So how do people move around? Well, Turkey tends to be sort of, we watch this chart every quarter, and Turkey tends to be this one that jumps around a lot, back and forth, back and forth. The global market moved up 9 spots, and the US moved up 11 spots. So, positive news for global investors, but, more specifically, very positive news for US investors. So let's take a look at the Edgar sector rotator. So I'll just refresh everybody's memory. This is something we talk about every quarter. So the Edgar sector rotator is a quantitative model that we've developed here in-house. It takes a whole bunch of factors and plugs those into a model, a whole bunch of economic factors, market factors, plugs those into a model, and then it spits out to us a recommendation in terms of overweighting a sector or underweighting a sector. So the S&P is made up of 11 sectors. You can see them over here, from materials through industrials and technology, healthcare, all the way down to consumer discretionary. So the model tells us either overweight or underweight. And then we do that. We overweight or we underweight it. Now for us, if we underweight something that underperforms the S&P. So let's just take energy, for instance. If energy does worse than the S&P, that's what our sector alpha is here. So the S&P for the first quarter did 11.32%. Energy only did 9.98. So energy was up, but it wasn't up as much as the S&P. So if we underweighted a stock or a sector, I should say, that underperformed the S&P, we call that a win. If we overweighted a sector that outperformed the S&P, so let's take a look at communication services here. We overweighted it. Communication services did 3.53%, better than the S&P's 11.32%. by 2.2%, well, we call that a win. So if we overweight something that overperformed, that's a win. If we underweight something that underperformed, that's a win as well. Now, if we overweight something that underperforms or underweight something that overperforms, we call that a loss. So for the quarter, there's 11 sectors in the S&P. We actually won on 6 of them and lost on 5 of them. So we were 6 and 5 on the sectors. If you're paying very close attention to these presentations, I think we've been 6 and 5 this quarter, 6 and 5 the last quarter, and 6 and 5 the quarter before. So, overall, we're doing slightly better than 50%. So what is the model telling us to do for Q2? So here we have all of our sectors. And what the model is telling us to do is to underweight materials, communication services, financials, industrials, consumer staples, real estate, and utilities. So those sectors were underweighting. Meanwhile, information technology and consumer discretionary were overweighting. And you can see here the light blue is what the weighting of the sector is in the S&P, and you can see the darker blue is what our weighting is. So for instance, communication services here, the weighting in the S&P is around 8%. We're going to go ahead and weight that at around 5 or 6%. Meanwhile, on information technology, the weighting is a little bit less than 30%. We're overweighting that sector, so we're going to weight that to about 35%. So we'll let you know next quarter how those all turn out. But this is what our model is telling us to do for this quarter. Now, this is not a recommendation. Of course, everybody's situation is different. Everybody's time horizon is different. Your risk preference is different. Your tax situation is different. So we're not actually recommending any of this. We don't actually have any client money in this, but it's just something that we like to look at on a quarterly basis. So let's take a look at how U.S. equities did for the quarter. Well, you can see the top performer, we've already seen this in a couple other slides, is this large cap growth. So large cap growth printed 11.4% for the quarter. Large cap in general, just across the board, did 10.3. Market wide, we had a solid quarter, 10% return. Large cap value, it didn't beat large cap growth, but it came in at a solid, almost 9%. Small cap growth came in at 7.58%. Small cap came in at 5%. And small cap value, really struggled to keep up at 2.9%. The U.S. market currently makes up 63% of the entire global market. Why is this important? Well, if you're looking at your portfolio from a sort of geographic diversification standpoint, you would want to have 63% of your holdings in U.S. equities. If you have more than that, then you're tilting more towards the U.S. If you have less than that 63%, you're tilting away from the U.S. So that's why we kind of like to keep track of that. This is up, as the U.S. market continues to sort of outperform its market cap relative to the rest of the world, continues to grow. So taking a look at international developed stocks, again, this would be those sort of non-U.S. countries that are sort of further along that economic ladder. Again, very similar to what we saw on the U.S. side. Growth in local currency had very strong performance. Large cap had very strong performance, value, and small cap down here. Across the board, a very good quarter. I will say that when you take your local currency, so let's say you're investing in Great Britain, when you take your pound and you convert it back to the US dollar, you actually only had a 6.91%. So this discrepancy between your local currency return and your US currency return is sort of that currency translation, either premium or discount in this case. So by investing in another country and bringing it back to the U.S., you're actually having less performance. And this has to do with the movement of the dollar relative to foreign currencies. International developed market makes up about 27% of the global equity market. Let's take a look at emerging market stocks. Again, you'll see that similar type dynamic between local currency return and US currency return. Again, when you converted your money back from whatever local currency it was to the US currency, you actually got less performance. But growth sort of topped the list here. This is the story across the board. Large cap came in second. Small cap actually did pretty well in a local currency. And then value, of course, did a little bit less. But when you bring your currency back, it's growth, large cap, value, and then small cap. And then the emerging market sector makes up 10% of the global equity market. Let's take a look at global fixed income. It hasn't really been a super interesting time for fixed income. You can see yield curves pretty much across the board have stayed fairly consistent, from the beginning of the quarter to the end of the quarter. We've had a slight increase in the U.S. Yield curve. Kind of have to squint a little bit to see it, but we have had a shift up. What's really interesting is this Japan for quite a while now, their yield curve has had negative short-term interest rates. That's now above zero. I mentioned that in an earlier slide. That's pretty interesting to see. You can see, there's some consistency among a lot of these yield curves, with Japan being a little bit of an outlier. Number one, it has sort of an upward sloping yield curve where most of the other countries tend to be fairly flat. Australia has maybe a slight upward slope. US fixed income, very similar to what we were talking about on the global fixed income, just not a lot to talk about here. One thing that is interesting, if we go back a year, we see we have these sort of high short-term rates and lower long-term rates. We have definitely seen sort of a seesaw type effect here where these longer-term rates have moved up. So you can see here 1 year ago, end of the first quarter of 2023, we had a very downward sloping yield curve that has really flattened up to where it's pretty much consistent rates across the board. We have shifted up a little bit in the U.S. from the end of 2023 to the end of the first quarter. This is going to continue to evolve, as we move forward into the year, especially if the Fed begins to decrease short-term rates. We might see this yield curve change shape a little bit. Okay, let's get into some Q&A. Of course, you can always ask questions in the chat. But when you register for our webinars, there is a place for you to ask questions. We had a couple questions come in with registration, which I always like to see because that allows us to put some time and effort into preparing a question for you. So if you have a question, be sure to ask it right now. But in the meantime, I'm going to go over some of the questions we had with the chat. So one of the questions was, what about the IPO market? What does that look like for 2024? So what we prepared here, what Patrick prepared actually, is a graph going all the way back to 2000 to show the number of IPOs in the year. Now, of course, 2024 is not done. We're only a quarter into it. So this is the first quarter of 2024, and we have 51 IPOs. I think that number is now 59. I think after next week, we'll have 59 IPOs. And this is really on pace to exceed 2023, 2022, and 2019, I believe. Now, obviously, we had a ton of IPOs in 2021. A lot of this were blank check IPOs, but there was just a lot of IPO activity in 2021 and in 2020 as well. So in terms of, where we sit right now, I think it's going to be a sort of an average year, maybe slightly above average relative to sort of these typical years if you take out 2021 and 2020. So really nothing too crazy on the IPO market. Of course, we are in an election year. If you don't know that, you probably don't have Wi-Fi underneath your rock, so you probably aren't watching this webinar anyhow. But we are in an election year. Everybody is always curious to know, well, what do markets do in election years? So that's exactly what this slide tells us. Now, this goes all the way back to 1928, so there's a lot of information on here. But what we can see is if you look at this sort of light green, that is the average return following election year. The blue is the average return during an election year. So we are in an election year, so we would be blue. This would be a blue year for us. Next year would, of course, be a green year. In an election year, on average, the S&P does about 11.57%. So that's not bad. I mean, that's probably slightly higher than what we would expect from the S&P in an average year. In the year subsequent to an election, you can see 10.67%. So a little bit less than an election year, but still probably more than what we would expect to see in an average S&P year. Notably, you can see there was a very negative year here in 2008. That was an election year, of course. 2008 was the financial crisis. It was a bad year for the S&P. It was a bad year for every market. Now, interestingly enough, in the very following year, 2009, we had a very solid year for the S&P. I think it was almost 30%. So you can have pretty drastic swings from year to year. Okay, so that sort of covers election year, the year following election year. So then another question we get is, well, who's better for the market, a Republican or a Democrat? Well, I'm not going to say who's better, but I'm going to let this chart sort of talk for itself. So red are Republican presidencies, blue are Democratic presidencies. And what you'll notice is on the whole, for the most part, pretty much every president, comes in at one level and leaves at a higher level. Now, Bush is an exception to that in recent memory. Of course, 2008 basically took away any gains that we might have had from the Bush presidency. Famously, we call that the lost decade. Basically we ended the Bush presidency where we began, maybe a little bit slightly lower. But for the most part, every presidency ends in a higher level than where we began. And that sort of meets our expectations as investors, right? I mean, markets tend to increase. Markets have more up days than down days. They have more up months than down months. They have more up quarters than down quarters, and they have more up years than down years. So over the course of history, we tend to see markets go up. So I always would encourage investors, it's kind of fun to say, well, if you're a Republican, you say Republicans are better for the market. If you're a Democrat, you say Democrats are better for the market. I like to encourage investors to sort of maybe have fun with that if you want. But when it comes time to invest and you think about investing and saving for the future, sort of put that to the side and just realize that overall, it's not one person, it's not who's president. Overall, markets tend to increase no matter who's running the country. But it is fun to sort of pay attention to the news and debate with your friends. There's really no definitive evidence about whether a Republican is better for the market or a Democrat is better for the market. It really seems to be fairly independent. Another question we get is about timing. Oh, is this the right time to get into the market? Is this the wrong time to get into the market? And, we like people to be in the market all the time. It's very hard to time the market. And that's what this slide really gets at here. If you would have taken $1,000 and invested it in the Russell 3000 index, so that's a bit more broad, it's got a lot more small cap in it. So if you would have invested $1,000 into the Russell 3000 in 1997, and you would have just let it ride up through 2023, that $1,000 would have turned into $10,550. So you would have been up 10x. If you would have just missed the best week in that period of time, which was the week ending November 28th, 2008, if you would have missed just the best week, your portfolio would have been worth $8,652. So almost a $2,000 reduction just by missing the best week. And I'm not talking about the best weeks. I mean, if you would have missed that one week, you would have lost $2,000. If you would have missed the best month, which was April, the month ending April 22nd, 2020, your portfolio would have been $8,279. So well under $2,000 less than if you would have been in the market the whole time. If you would have missed the best 3 months in that period of time, which was June 2020, think COVID, your portfolio would have been $7,300. And if you would have missed the best 6 months, which was September 4th, 2009, coming out of the financial crisis, your portfolio would have been worth $6,700, almost $4,000 less than if you would have been invested the whole time. So, we really try to press on people that it's not really about timing. You just have to be invested, and you have to, just focus on the long term. So let's see. With that, I really want to thank everybody for, coming in and joining us for this webinar. Of course, look forward to our Q2 webinar coming up in 3 months. More information will be on our website, on social media, in our newsletter, of course. So stay tuned for that. You can register as soon as you see those registration links come out. Of course, you can always reach out to us. There's a whole host of ways to reach out to us. You can go to our website, check out our daily blog on there. You can go to our LinkedIn page. We're very active on LinkedIn. Check out YouTube. This video will be on there. Some of the older quarterly presentations will be on there. We also have other sort of one-off videos that we record on our YouTube station. So definitely go ahead and check out our YouTube channel. Of course, you can pick up the phone if you're old school, give us a call. You can hit us up on Instagram. We're also on Facebook. So there's a whole host of ways for you to get in touch with us. And we really just appreciate you joining us today and look forward to talking to you in about 3 months.